Hey, this is Josh. Today is Monday, July 24th. Today was a large trading range day. Pretty strong selling overnight. I came in somewhere around in this small, tight trading range. The bulls had formed a double bottom. This was a sell climax, likely to lead to a second leg up. So the bulls had formed a double bottom here with here. And this was a low 2 sell setup into the bottom of what was at that point a small trading range. Making this a weak sell setup, and you can consider this a double bottom pullback. If it's also a failed low 2, failed bear breakout below the prior higher low. I don't care for buying above here on a stop order because there's a possible. It's at that time there was a small bear trend line in here, so it was possible the bears sold with limit orders above that bar. However, if you wait for this bar to close, probably strong enough probability to buy above or try to get filled somewhere back around the original entry price for a scalp up. You can argue prices became always in long here for at least a test of these highs, small second leg up after the failed low 2 and bull entry and follow through bars. That made this a weak low 1 buy setup, but I highly doubt you got filled unless you had your order somewhere up above this close, possibly around this close, but again, doubtful. Hard to get filled there because the pullback was not very far. Not other than this entry, not many great entries to get into on this rally up to the high of the trading range. It turned into, this was a weak sell signal for you can consider it a low 2 with this the first entry and the second entry. Personally, I would consider it a first entry off the top of the trading range, making this the second entry here, which was a bull bar again. So not all that great of a signal. Selling above this bar is a weak high 1 at the top of a trading range. You can argue is a reasonable thing to do. Looked like prices were attempting to form a bear channel, a broad bear channel, which if prices had come up here or around here, I would say that's probably the case, but since prices were not able to make it back up to here, I question if this channel is valid. So the bulls who had bought this close scaled in lower, and you can see they exited during this bar and then here as well, and this is probably what led to this strong bear breakout. So prices became always in short here on the bear follow-through bar. Entered a sell to close bear trend. Selling above this bar, again, only slightly ticked above the bar, like 1 micro pip, so hard to get filled unless you're entering lower, betting on the spread or including the spread in your entry price. But at this point, you're selling in the middle of a tight trading, in the middle of a trading range, so 50-50 probability. If you're willing to scale in, reasonable thing to do. If not, you can consider selling below here for a swing short, but again, you're selling into the low of, at that time, the low of the day. So better to take this as a low 1 swing short. Bear breakout, bear follow through here. Reasonable to sell this close as a bear breakout of the trading range. Prices went 2 more bars and tested near. This was an important close for whatever reason overnight, and you can see prices formed a tight trading range right around that close, and that close is right in the middle of that tight trading range. That tells me that price level for whatever reason was important. This is a very interesting pattern here. So the bears, this was a reasonable sell to close bar, and this bar ended the sell to close bear trend. So the bears who had sold this close were scaling in, but if you notice, prices never were able to reach that close. So look at how many times the bears tried. They tried here, 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 and here. They tried arguably 3 to 4 times to reach that close and were unable to every time. It's easy to get trapped in or trapped out of trades during this tight trading range. However, if you know and understand what's happening, it's a good opportunity because you know that these bears are trapped and will be forced to either scale in higher or exit. Ultimately, they scaled in, but a lot of times this will lead to a strong rally and a possible really strong bull trend. So if you realize that buying this was, you could also consider this a sell climax for a second leg down from here. It's stronger selling pressure than we've seen overnight and all morning. So it was not unreasonable to consider this a sell climax and look for a reversal and 2 legs up. And you can see we got 2 legs up from there, arguably a wedge bear flag. But so this buying above this bar for the sell climax, not high probability, low probability, maybe 40% weak swing buy. This was a stronger second entry for that entry, so reasonable to buy above here. Probably at least 50-50 probability, so okay, swing buy. The bears tried for a failed high 2 and a variant of and a low 2 here. And like I said, this is a weak area to sell on a stop. You're selling into the low of the day after a climax and reversal, and the seller closed bears are trapped. So selling on a stop down here. This is where the strong bears are exiting and the strong bulls are buying. So you do not want to sell on a stop down here. And you can see if you did at any point, you would have gotten stopped out or trapped. So here was a buy setup for you can argue it's a second entry for here or here. You can also consider it a small wedge bottom with 3 pushes down, 1, 2, 3 pushes down, and a failed low buy setup for a failed low 2, first entry, second entry failed, buy setup for the failed low 2 in reversal. The bulls got a test of the EMA, but again were unable to break above the small trading range. And this is also an expanding triangle, a nested one. And you can see it grew into a larger pattern, and it's actually been in effect for the rest of the afternoon. So bears tried for a wedge bear flag and failed failure. Continuation from the expanding triangle. You can also consider this a small spike in bear channel. So here's a small bear channel. Bear spike and 3 pushes down, 1, 2, 3 pushes down in the bear channel, but the bears could not break below the previous low, making this a pretty reasonable buy setup. It's a wedge bottom and a larger failed low 2, and it became an outside bull bar. You can also consider it a second entry for any of these. It's also a high 4 buy setup. So reasonable to look for 2 legs up from here. Bears were unable to break below this low from the overnight, and the bulls formed a higher low here. And like I said, strong bears are exiting through here, strong bulls are buying. So a good bull entry, good bull follow through, became always in long for a second leg up here. Did not, you can buy this close if you're an always in trader, but did not get a great entry until over here. This was a big bull breakout at one point, but could not close on its high and could not fill this gap, this breakout gap here, and also this gap here. However, it was a weak sell setup, so buying below this bar was not unreasonable, expecting a breakout pullback and a second leg up. The bears tried for a second entry here, and again, weak sell signal, so okay to buy below here. However, it is a second entry, first entry, second entry, so a little riskier, but if you're an aggressive trader, you probably took that entry for at least a scalp up. Prices were also in a small bear channel here. So that's also another reason why prices could never quite break above here. This was not a weak. This was not a strong buy setup. Limit order entry from here, acceptable thing to do. Not a great setup to buy above this bar. You can consider it a larger failed low 2 either here or first entry, second entry, or first entry, second entry variant of a high 2, but you're buying above a bear bar. So not the best entry. Like I said, the bulls could not break out strongly above this trend channel line. Sorry, cut off at 10 minutes. So This was a larger a larger low two sell setup. It's also, you can consider, it's a second leg up from the sell climax. Bears were trying to form a bear channel, and it's also a wedge bear flag where this is the first push, second push, third push. So reasonable to look for a swing below here, since the bulls were unable to generate enough strength. And if you look, the bulls could not hold prices back above the earlier opening range. They got a close above here, but the next bar was a bear bar. This was I would say this was a lower probability sell setup below this bar. However, selling below this bar was stronger. You had a failed high 1, it's a variant of a failed high 2, first entry, second entry. It's also a weak high, it was a failed high 1 at the top of a bear flag, making this a reasonable swing down for a test of these lows, possibly a new low or start of a bear channel. The bulls tried for a high 2 buy setup here, which turned into a failed high 2, so acceptable scalp to sell below here. Bears it became clearly, it was back to always in short here with the bear entry and follow through. Definitely back to always in short on the bear breakout and follow through of the bear channel. But prices were likely, at least I thought they were likely to come back and test these highs for before a sell-off began, a strong sell-off. But as these bulls exited, prices entered another sell-to-close bear trend, but found profit taking below this overnight low. This was also near a measured move down based on the opening range. So here's the opening range, measured move down. Sorry, slight interruption. So profit taking below the low of the day. This was not a strong buy setup, but so I would not buy above this bar, but this was a reasonable buy setup for a second entry off the bottom of the trading range and failed low 1. That's also a failed breakout to a new low of the day. So there was pretty strong, good bull entry bar, good bull follow through, arguably back to always in long at this point. Here, it looked like prices were entering a bear channel. And prices, so, and at one point it looked like it was steeper. It looked like it could have been like so, but prices just weren't able, when prices were unable to reach down here and also did not hold here, I questioned if that was legit. Now it's looking more like this is the bear channel here, and we just got the break of the bear trend line. So bull became back to always in long here, off the bottom of a trading range, second entry. However, the bears were still active, and this was a weak sell setup below the bull bar. This was a stronger sell setup below the outside bear bar. Selling below this bull bar, it was a failed high 1 at the top of a possible bear flag. It's also a low 2 sell setup. So bears got entry and follow through, but ultimately exited around this close and formed a second leg up. Whenever prices form which you could say this is a weak bear trend, a weak bear channel, but when prices are in a strong trend, just know that when prices make a high or low, it's more likely the start of a second leg up, which is a correction, more likely than the start of a new bull trend. So prices formed a higher low here. You can argue prices are in a bear channel, so it was not unreasonable to look for a sell setup for a test back down, possibly here or here. There's also this measured move target down here, which is based on this trading range. The entire daily range is in a trading range around 20 pips or so. So there's a chance of a sell to close bear trend into the close to double the daily range. I would expect a sell to close bear trend more than a buy the close bull trend, because if you look at the daily chart, the bears want today to close on its low for a sell signal. And up until this point, prices have remained at least near the low. And the bulls, this is the first strong buying pressure of the day. So it's reasonable to expect a possible sell to close bear trend into the close. However, you never know what's going to happen. So I've got some questions from a trader from Friday that I didn't get a chance to get to, and so I will go over those now. I just want to say this is a reasonable sell setup for a failed high too after the first break of the bear trend line. So not unreasonable to look to sell below here. Okay, first question. What are surprise bars for you? I guess they are movements that you were not expecting. What could they lead to and how to handle them? Well, a surprise bar for me is just whenever I expect something to happen and the opposite happens. So you can consider it the lower probability event. That's what I consider a surprise bar, but Al and other traders talk about bull give up or bear give up bars. And those are also surprise bars. So like say below a fail, this would be a good example. So you had the bulls were attempting to form a high 2 and a larger second leg up. However, they were unable to, and so they gave up during this bar. So you can consider like a failure, a give up bar, or just when the market does something unexpected. Can also kind of consider this a surprise. It was a surprise for me because I thought this was a weak sell setup. Although it is at the top of a trading range, I thought prices were at least going to test a little higher, possibly above here before the failed breakout. But like I said, the bulls were exiting around this close, so the bulls gave up during this bar. You can consider that a surprise bar. And how, as far as what could they lead to and how to handle them, I've heard other traders talk about surprise bars leading to 2 legs in the opposite direction. I don't necessarily consider that, but as far as how do I handle them, if I'm in a trade, I'm going to get out. Otherwise, I will just say, wow, that shouldn't have happened, and look for an entry if there's follow through in that direction. Second question: bull and bear channels are also trends, but they are weaker. So how do you expect the breakout from the bull or bear channel? In the case of the bull channel, it's more likely a bear breakout, and in the case of a bear channel, it's more likely a bull breakout. So is it reasonable to buy low in a bull channel knowing that it is likely to break to the downside? Well, yeah, remember that every bull channel is a bear flag, every bear channel is a bull flag. So yeah, you are right that prices are likely to eventually break out of the bear channel into a bull trend, but until that happens, it doesn't happen, and until that happens, the bear channel is in effect. And it also depends on the channel. If it's a tight channel, then no, I would not be looking to buy in a tight bear channel. If it's a broad bear channel like today, I would say, yeah, you can buy low and sell high. You have to remember a channel is a slanted trading range. So although the probability favors one side, it does not favor them strong. It does not greatly favor them like in a strong trend. So it depends on the channel. So if like a day like today where it's a broad bear channel or a weak bear channel and it's also a trading range day, yeah, absolutely buy low, sell high, scalp, or you can swing with the trend. It really depends on the style of trader you are. But as far as expecting a bull breakout of the bear channel at any time, I would say that happens more after 3 pushes with the channel, and it's less common to break out against the channel until there's been strong buying pressure in a bear channel, or vice versa. Or if prices are in a trading range, like I think it was Friday, remember that trend lines don't tend to hold, so you might get two pushes and it looks like a channel is forming, and then on the third push the trend line fails and prices rally. I think Friday was a good example of that. Next question. In channels, we connect reversals to see what price is doing, but many times price overshoots and comes back to the channel. What do you expect? What do you expect when prices do so? Channels are never perfect, so how to differentiate from one channel from the other? Well, remember, a channel is a slanted trading range, so many times price overshoots. So yeah, okay, so whenever price breaks out of the channel, like breaks the trend line, it should test back. It should test the trend extreme, at minimum the middle of the channel, where so like in this bear channel, again similar to a trading range. So if you drew a line in the middle of this bear channel, say somewhere around here, you can consider this 50-50 probability, and you can see prices swing back and forth on either side. So in the middle of the channel, it slightly favors the bears, but as the price reaches the trend channel, starts to favor the bulls as the bears take profits and the bulls buy off of the bear trend channel, holding for a test of the trend line. So as far as what to expect, if prices break the trend line, then expect to look for a 2 to 3 leg test of the trend extreme before a strong reversal, or before entering a reversal in the opposite direction. And right, yeah, channels are never perfect. How do you differentiate one channel from another? It really depends on the day. Like if like here, so today this was a seller closed bear trend, probably a spike on a higher time frame chart, and it's also a channel on a lower time frame chart. So a channel, I would consider this a micro channel, which it is, and then this would be a broad bear channel. As far as how to differentiate what's going to happen, you just never know. You just have to follow the price action and make your best educated guess. Hopefully that answers your question. What is the best thing you can do in tight channels or even micro channels? They always seem to lead to a huge breakout, but they still go on. Unfortunately, you do end with a big breakout bar. I'm not totally sure I understand the question, but again, it depends on the style of trader you are. So if prices are in a tight micro channel, you might, if you're an always-in trader, you're probably going to just enter at the market, stop below the channel and hold for a second leg up, or always-in flip. If you're a scalper, you're probably going to buy below a bar, like a week low 1, week low 2. If you're a swing trader, you're probably going to buy above a high 1 or a high 2 buy setup. So it really depends on the style of trader you are, but as far as the breakout, they always seem to lead to a huge breakout, but they still go on. I'm not totally sure I understand your question, but if it's a breakout against the channel, it probably broke the trend line, and therefore prices are likely to test the high of the channel. And sometimes if it's a strong spike, it'll form a broader channel. But I'm not totally sure I understand the question there. What is the best thing to do when there's a breakout in the wrong side of the trend? Let's say a bull breakout in a bull channel. You know that it's likely that price is going to return to the trend line, but seems to go farther. Does it matter the number of bars and how to recognize them? Yeah, a bull breakout of a bull channel is often a climax, likely to lead to a reversal back into the channel and test of the trend line. If, however, bulls get follow through, like a breakout and then follow through bar of the channel, like I think it was last week or the week before, there were a couple examples of that. There was a bull channel and bull breakout above the bull trend channel line, and then prices made a measured move up. So The measured move can be there can be a measuring gap after the breakout, or it can be based on the height of the channel itself. So say there was a bear breakout of this bear channel here, then the measured move could be based on the channel itself. So like the new trend channel would be down here, like so. Or like I said, it can be off of a measured move, or a measuring gap, sorry. And if it's a wedge, then it can be on the height of the wedge. So say, so you have a small wedge here. Say this reversal up had failed, prices would likely reach a measured move down based on the height of the entire wedge. So somewhere down around in here. The other alternative is it's a climax. So and it often is, if there's especially after the third push up, if there's a strong breakout with the trend. So like at the end of a trend, like at the end of a bull. Sorry, I cut off again, but yeah, so if it's a bull breakout at the end of a bull trend, more likely to become an exhaustion, a climax, sorry. Exhaustion and climax are the same thing. Do you pay attention to gaps and negative gaps in order to see if price is going to continue the trend? Yeah, I absolutely paying attention to gaps is very important to a price action trader. Gaps, whenever a gap is formed, the counter trend traders are trapped. So it shows you that the strength favors one side. So yeah, absolutely, I pay attention to gaps. I try to decipher if it's going to become a measuring gap, a breakout gap, or an exhaustion gap. If it's a measuring gap, then I'll expect a measured move up or down. If it's an exhaustion gap, I expect it to get filled. If it's a breakout gap, I expect prices to test it and probably not fill it. And if they do fill it, then I would think that the trend is not as strong. So here we had a breakout gap. The bears were able to fill it. So had the bulls kept this breakout gap open, I think that we would have gotten a stronger rally, probably up to here. But since the bears were able to fill it, that shows you that the bears are strong enough to at least reach. So say a bear had sold above here, they were theoretically capable of scaling in and exiting break even. So yeah, gaps are very important. Negative gaps, I don't necessarily pay as much attention to. However, I will say I do pay attention to when gaps are being filled. So, like if there's a bull trend and now prices are transitioning to a trading range and the bears are filling bull gaps, then I know that the bull trend is weakening. But not so much negative gaps. I know Al talks about them a lot, but I personally do not pay too much attention to negative gaps. Last question. What is the best way to see if counter trend traders are making money? For changing stop orders to limit orders, how else can you apply this to your trading? Yeah, analyze the price action. If the counter trend traders make a scalper profit with the limit order, then prices are likely to transition into a trading range. So I'd have to go back and find an example, but basically if prices are trending in a strong bull trend and now all of a sudden prices break to a new high and the bears are able to make a scalper's profit without scaling in, that's a sign of bull profit taking and limit order bears initiating shorts. So prices are likely to transition into a trading range and the bulls are likely to start taking profits. If both sides are making profits on a stop, it's likely, at least my theory is, that prices are in a trading range or a weak a weak or a broad channel. So like here, if this had been a strong bull trend, bears should not be able to make a scalper's profit selling below this bar. However, since they were able to, you can conclude that prices are in a trading range. Same with over here. If this is a strong bear trend, bulls should not be able to make a scalper's profit with the stop above a bar, yet they did, so prices are likely to lead to a trading range. So all good questions. I hope that I'm answering them. I hope you have more. If anybody else has any questions, feel free to leave them below or reach out to me some other way, and I would be happy to help to answer them. All right, hope everybody has a good night.